One of the most exciting frontiers in crypto right now isn't just happening on the blockchain. It's happening at the intersection of artificial intelligence and finance. We're talking about AI agents, autonomous programs powered by machine learning and natural language processing that can analyze markets, adapt to conditions, and even execute strategies on their own. For new investors, the easiest way to think about AI agents is this. They're like smart assistants for crypto. Instead of staring at charts all day or stressing about missing a trade, you can have an AI agent monitor the market and act based on the rules or strategies that you set. For seasoned traders, the appeal runs deeper. These agents don't just follow pre-programmed scripts like the old bots. They learn. They can digest massive streams of on-chain and off-chain data, everything from wallet flows to sentiment on Twitter, and adapt their decisions in real time. That's why this space has exploded into a $13 to $25 billion market in 2025, with projections hitting $40 billion in just 5 years. But here's the key point. While the potential is massive, the risks are also real. AI agents are only as good as the data they consume. Feed them bad inputs, and you'll get bad outputs. They can misfire, be exploited, or even overfit to past market conditions that no longer apply. So while they offer incredible efficiency, they also require careful oversight. The difference is clear. Traditional trading tools execute. AI agents evolve, and in 2025, that evolution is opening up opportunities that didn't exist even a few years ago. But it also means knowing where the pitfalls lie. So, how do these AI agents actually work? Now, at the core, it's a 3-step process. Gather data, make decisions, take action. First, they collect information. On the blockchain side, that might mean scanning prices, wallet flows, and liquidity pools. Off-chain, they're pulling on sentiment from platforms like Twitter, news headlines, even macroeconomic data. The idea is to see the full picture, not just one slice of the market. Next comes the decision making. Instead of running on rigid rules like old school bots, AI agents use machine learning models to process all that data. Some use reinforcement learning, where the system learns by trial and error, adjusting strategies based on what works. Others rely on time series models that detect patterns in volatility or correlations across assets. The goal is the same: turn raw data into predictions and risk assessments in real time. Finally, once a decision is made, the agent executes. That could mean placing a trade through an exchange API, rebalancing a portfolio, or even interacting directly with a smart contract on Ethereum or Solana. Integration tools like Wallet Connect make this possible without the agent ever needing to hold your private keys. For new investors, the good news is you don't need coding skills to use these systems anymore. Many platforms now offer user-friendly dashboards where you can approve actions before they happen. Think of it as setting guardrails so you stay in control. For seasoned traders, the power lies in customization. You can tweak strategies for high-frequency trading, connect agents to multiple exchanges and fine-tune them to respond to specific signals, whether that's funding rates, whale alerts, or cross-chain arbitrage opportunities. At their best, AI agents feel like having a 24/7 analyst who never sleeps, constantly scanning data, weighing probabilities, and executing with precision. But remember, the quality of the outcome still depends on how well the system is trained and monitored. So one of the biggest questions people ask about AI agents is, can they work with non-custodial wallets? And the answer is yes, and that's where things get really interesting. Agents can connect to wallets like MetaMask, Trust Wallet, or Phantom through secure protocols, again, such as Wallet Connect. That means you don't have to hand over your private keys. You stay in control. The agent can suggest or prepare a transaction, but it still requires your approval before it goes on-chain. For everyday users, this setup preserves sovereignty. You get the benefits of automation without the trade-off of giving a third party custody over your assets. But there is a trade-off still. Manual approvals do slow down the process, so you don't always capture every microsecond arbitrage opportunity. For most investors, though, that's a worthwhile balance between speed and security. Now, for beginners, the best approach is to start simple. Connect your wallet only to well-known, reputable platforms and approve only the transactions you fully understand. It's tempting to hand over more control for convenience, but believe me, that's where risks really start to creep in. For advanced traders, AI agents integrated with non-custodial wallets can be a powerful tool for optimizing DeFi strategies, automating yield farming, managing liquidity pools, or monitoring on-chain activity with whale alerts tied to your wallet. You can even use explorers like Etherscan to verify exactly what's happening in real time. There are already examples in the wild. Projects like Virtual's Protocol, Fetch AI, and Krill.io have built frameworks where AI agents and non-custodial wallets work hand in hand. The vision here is clear. Give users more freedom and flexibility while keeping private keys out of reach. Now, of course, challenges remain. Technical setup can feel intimidating, and for power users, manual approvals can limit efficiency. But the upside is huge. You get a system that's both intelligent and sovereign. So what can AI agents actually do in the crypto world? Well, the short answer is a lot. Their applications stretch from simple trading tools to complex DeFi optimization, and even into governance and NFTs. The most common use case is automated trading. AI agents can monitor markets 24/7, scanning hundreds of tokens at once, and execute trades the moment certain conditions are met. Unlike humans, they don't get tired, they don't panic, and they don't chase FOMO. That alone makes them powerful allies in a volatile market. Beyond trading, agents can also handle portfolio management. Instead of you manually rebalancing assets, an agent can dynamically shift your holdings based on risk models, liquidity conditions, or even your personal targets. Tools like Vader AI are already doing this, offering systems that adapt as markets change. DeFi is another big arena. Agents can manage yield farming positions, optimize across liquidity pools, and even detect fraud patterns faster than humans can. Projects like H4CK or Hack are building frameworks where AI agents flag suspicious activity before it drains liquidity. It's pretty awesome. And it doesn't stop there. In DAO governance, agents can cast votes automatically based on your preferences. In NFTs and metaverse, they can promote tokens, negotiate trades, or even interact socially on platforms like Twitter. Truth Terminal is one example of this new wave. Agents that act like autonomous personas online. For new investors, the takeaway is that you don't need to start with complex strategies. There are free platforms that let you test out simple automation safely without coding or big capital commitments. For seasoned traders, the possibilities are almost endless. You can design AI agents to run advanced arbitrage plays, trade based on sentiment analysis from social media, or deploy cross-chain strategies that no human could execute quickly enough. The bigger trend here is what some are calling DeFi, the fusion of decentralized finance and AI. Tokenized agents, low-code platforms like Coinbase's Based Agent, and new marketplaces for renting agent services are emerging fast. We're heading toward a future where AI agents aren't just tools, but active participants in the crypto ecosystem. If you're wondering where to actually find these AI agents in the wild, there are already a number of prominent projects leading the charge in 2025. Some focus on creating full ecosystems of agents, while others provide infrastructure or specialized utilities. One of the biggest names is the Artificial Superintelligence Alliance, also known by its token, FET. It provides a multi-agent framework that supports trading, DeFi, and broad applications across Web3. Then there's Virtual's Protocol with the Virtual token, which focuses on tokenized AI agents running on the Base blockchain. Imagine building and deploying your own AI-powered character or trading assistant that lives entirely on-chain. On Solana, AI16Z operates as a DAO with a strong focus on AI-driven trading. Fala Network is another important player offering secure AI processing so sensitive data can be handled without compromising privacy. And the list keeps growing. Hive AI, AIXBT, BitTensor, The Graph, Theta, DEXE, Arrowweave are all pushing the space forward in different ways, whether through infrastructure, computing, or specialized AI-driven services. The bottom line, this sector is no longer a fringe experiment. It's a rapidly growing corner of the crypto market with real projects, real capital, and real volatility. Now, up to this point, AI agents might sound like the perfect solution: fast, tireless, and adaptive. But like everything in crypto, the story isn't all upside. These systems come with real risks that investors need to understand before completely diving in. So the first challenge is data. AI agents are only as strong as the information they're trained on. If the data is inaccurate, incomplete, or manipulated, the agent's decisions will reflect those flaws. We've already seen examples of garbage in, garbage out, where bots chased false sentiment signals or overfitted to patterns that no longer apply. Then there's the technical layer. Many agents rely on APIs or smart contract integrations, and both are vulnerable to exploits. A compromised API key or a faulty smart contract can wipe out funds faster than any human trader could react. For newcomers, even the setup process can feel like a barrier. Connecting wallets, configuring strategies, and understanding permissions all create friction points where mistakes or scams can creep in. Market risk is another big one. Just because an AI agent can operate 24/7 doesn't mean it can predict black swan events or sudden regulatory shocks. Over-reliance on automation can give traders a false sense of security. When volatility spikes, poorly monitored agents can amplify losses instead of protecting against them. And we can't ignore regulation and ethics. If an agent is operating in DeFi, does it comply with existing rules? Could it be exploited for wash trading or market manipulation? There's also the bigger question of systemic risk. If too many traders rely on similar AI-driven strategies, their actions could unintentionally synchronize and cause cascading effects in the market. For new investors, the lesson is simple. Start small, test cautiously, verify every output, and don't hand over full control to an agent you barely understand. For seasoned traders, the takeaway is diversification. Don't rely on a single agent or strategy, and regularly audit performance to make sure models aren't drifting off course. AI agents offer powerful opportunities, but only when paired with human oversight and strong risk management. Now, to really understand where AI agents fit into the crypto landscape, it helps to compare them directly to retail investors, the everyday traders like you and me. Well, I don't trade so much, but you know what I mean. The biggest difference is decision-making. Retail investors often rely on intuition, gut feelings, or emotions like fear and greed. AI agents, on the other hand, are purely data-driven. They don't get rattled by red candles or overexcited by green ones. That emotional neutrality is a huge edge. Speed and scalability are another factor. An AI agent can analyze thousands of data points in milliseconds and execute trades across multiple chains simultaneously. A human might be able to track a handful of charts at once, but never at that scale and never 24/7. Risk management is also different. Humans tend to be inconsistent, sometimes setting stop losses, sometimes ignoring them, often letting emotions override discipline. AI agents stick to their models. They execute rules precisely, whether that means cutting losses early or scaling into winners methodically. But here's the catch. AI agents aren't perfect. They don't have human intuition. When truly novel events hit, like a sudden geopolitical shock, an unexpected regulatory announcement, or even a flash crash caused by cascading liquidations like we recently saw the first week in October, Humans can sometimes adapt more creatively than algorithms. An agent can only react within the framework it was trained on. That's why the best approach isn't to choose one over the other, but to combine them. AI brings consistency, speed, and emotionless discipline. Humans bring adaptability, context, and judgment in unfamiliar situations. Now, together, they cover each other's blind spots. For new investors, using AI agents can be a way to learn without falling into common traps like panic selling or chasing hype. For seasoned traders, integrating AI into your toolkit can provide an edge in high-volume, high-frequency environments where speed and precision make the difference. AI agents aren't here to replace retail investors. They're here to augment them, giving those who embrace this technology a sharper edge against those who resist it. Now, if there's one area where AI agents really shine compared to human traders, it's in dealing with behavioral biases. Retail investors are notoriously prone to them. We've all seen it. FOMO kicking in when prices pump, herd mentality when everyone piles into the same trade, loss aversion that makes it painful to cut losers, or confirmation bias that keeps us glued to bullish narratives while ignoring a lot of other red flags. These psychological traps create what's often called the behavioral gap, where investors underperform the market by 1 or 2% or more simply because emotions get in the way. Now, institutions manage these biases better, but they are not immune. Traders at big funds may have structures, committees, and risk controls, but they're still human. Emotions and narratives creep in, even in professional settings. AI agents, by contrast, don't have emotions to begin with. They don't feel fear, greed, or regret. That means they're far less susceptible to the classic retail traps, but that doesn't mean they're flawless. Their biases come from a different source: data and algorithms. If an AI model is trained on skewed data, or if it overfits to past conditions that don't hold in the present, its decisions can be just as flawed, just in a different way. Issues like model drift, where performance decays over time, are the AI equivalent of human bias. So by understanding your own biases and leaning on AI tools to counteract them, you can avoid many of the mistakes that drag down retail performance. In short, AI doesn't eliminate bias, it changes the form it takes. But when you understand both human and machine limitations, you can design a system where they balance each other out. If you want proof that AI agents are more than just hype, take a look at what institutions are doing. Banks, funds, and exchanges have already integrated these systems into their core operations. Exchanges like Binance use AI agents to monitor markets and flag anomalies in trading activity. BlackRock has woven AI into its Aladdin platform, managing trillions of dollars with algorithms that balance portfolios, assess risk, and spot inefficiencies. Even traditional banks like DBS are experimenting with AI-driven sentiment analysis and DeFi integrations. Now, for hedge funds, AI agents now run strategies that used to require teams of analysts, things like high-frequency trading, fraud detection, or cross-market arbitrage. Platforms like Numer AI crowdsource AI models to predict financial outcomes, while custodians like Fireblocks provide institution-grade tools for securely connecting AI agents to crypto infrastructure. Now, the key difference between institutions and retail is scale. Institutions have access to proprietary data, cutting-edge infrastructure, and regulatory frameworks that let them deploy AI at a level most individuals just can't. And yet, the principles are the same. Use agents to process massive amounts of information, reduce human error, and act faster than any manual team could. What's most telling is how institutions use AI to counter their own weaknesses. Even in highly structured environments, human bias still creeps in. By handing repetitive or high-stress decisions to agents, institutions reduce the emotional noise and free up people to focus on strategy. That same principle can be applied at any level of investing. So by now, you may be wondering, how do you actually get started with AI agents in crypto? The good news is the barriers to entry are lower than ever, but the approach you take depends on your own experience level. For new investors, the best starting point is user-friendly platforms. Services like Krill.io or Haas Online lets you test AI-driven strategies for free or at very low cost. Many of them require no coding, just connect your wallet, choose a strategy, and approve transactions as they come through. Think of it as a safe sandbox where you can learn the ropes without risking too much capital. The basic setup looks like this. First, choose a non-custodial wallet like MetaMask or Trust Wallet. Next, connect it to the AI agent platform using a secure protocol like Wallet Connect. Then configure your strategy. Maybe something simple like rebalancing your portfolio once a week or setting buy and sell signals based on moving averages. Finally, monitor the results. Even if you start with very small amounts, the experience is invaluable. For seasoned traders, the focus is on customization and scalability. Platforms like 3 or even fully custom-built agents allow you to backtest strategies, retrain models, and integrate across multiple exchanges. The key here is discipline. Backtesting ensures your strategy works across different market conditions, while regular retraining keeps your models from drifting into irrelevance. A few best practices apply to everyone. Always do your own research. It isn't just a slogan, it's survival. Diversify your strategies and agents so a single failure doesn't wreck your entire portfolio. And always, always, always keep your private keys secure, no matter how convenient a platform might seem. And above all, remember that AI is a tool, not a crystal ball. The best results come from a hybrid approach, letting the agent handle speed, repetition, and emotionless execution, while you provide oversight, creativity, and judgment. Now, whether you're testing your first free tier bot or deploying a network of agents across chains, the principle is the same. Start small, stay curious, and build confidence step by step. Because these agents are reshaping crypto by bringing speed, efficiency, and consistency to trading and DeFi. They help investors avoid emotional pitfalls and scale strategies in ways that humans alone just can't. But they're not perfect. Bad data, technical flaws, or blind reliance can turn strengths into risks. The real edge comes from balance. Let AI handle the execution while you stay in charge of strategy and oversight. That's how you get the best results, whether you're new to crypto or managing complex portfolios. And remember, crypto is high risk. This is educational, not financial advice. Always do your own research. If you want to dive deeper into tools and strategies that help you invest with clarity instead of emotion, visit learningcrypto.com. Thanks so much for watching. I'll see you in the next video.